Hello everyone and welcome to our CIP C11 Principle and Practice of Insurance course. In this video, we are going to build the foundation for understanding insurance. We will start with one of the most important words in insurance, risk. Then we will learn about pure risk, speculative risk and different types of insurable risk, perils and hazards, and finally one of the most important concepts for insurance claims, proximate cause. These concepts are important not only for understanding insurance but also for recognizing the correct answer in CIP exam questions. So let's start with the basics. What is risk? Let's begin with the word risk. In simple terms, risk means the chance of loss. Risk is part of everyday life. For example, when you cross the street, there is a chance that you could be injured. If you own a house, there is a chance that the property could be damaged by fire or theft. If you own a vehicle, there is a chance that you could have an accident. Even a student faces risk. If a student doesn't study for an examination, there is a chance of failure. So the easier definition to remember is risk, chance of loss. Insurance exists because risk exists. If there is no risk, there can be no insurance. However, not every type of risk is insurable. And this brings us to our next concept, pure risk and speculative risk. Example, imagine that you own a car. Every time you drive it, there is a possibility of an accident. The accident could result in damage to the vehicle, medical expenses, or loss of income. The possibility of loss of risk. So if the question asks, what is risk? Remember, risk, chance of loss. Now let's look at the two important types of risk, pure risk and speculative risk. Let's start with the pure risk. Pure risk involves a chance of loss but no chance of profit. For example, suppose you own an automobile. If you have an accident, your vehicle could be damaged and you could suffer financial losses. But you cannot normally make a profit from the accident. That is pure risk. Now let's compare with the speculative risk. Speculative risk involves a chance of loss and a chance of profit. A typically business operation is an example. A business owner may make a profit or the business may suffer a loss. Gambling is another example. If you make a wager on a game of dice, you may win or lose money. That makes it speculative risk. So here's the key difference. Pure risk, loss but no profit. Speculative risk, loss or profit. And this distinction is extremely important because insurance is concerned only with pure risk. Speculative risk is uninsurable. Example, you own a house. There is a possibility that a fire could damage the house. So that is pure risk because you face a potential loss, not a profit. Now imagine you start a business. The business could make money or lose money. So that is speculative risk. Remember, pure loss, no profit. Speculative risk, loss and profit. So exam tip, if you see business, gambling or lottery in a question, so think speculative risk. If you see fire, collision, theft or accident damage, so think about pure risk. Now we know that insurance doesn't cover every type of risk. Insurance is concerned with pure risk. A simple test for determining whether something may be insurable is to ask two questions. First, is there a chance of loss? Second, is there a chance of profit? If the answer is chance of loss, yes, and the chance of profit, no, then the subject matter may be insurable. So remember this simple exam formula: loss, yes, profit, no. Pure risk may be insurable. So exam tip: be careful with the word may. The textbook says that if there is a chance of loss and no chance of profit, the subject matter may be insurable. Do not automatically assume that every pure risk is covered by every insurance policy. So insurable risks divided into three broad categories: personal risk, property risk, and liability risk. So let's look at each one. Personal risk. Personal risk means involves the chance of loss arising from a person's death, physical disability, old age, or unemployment. So personal risk is mainly about the person's life, health-related disability, or income. So property risk. Property risk involves the chance of loss arising from destructions of or damage to property. Property losses are divided into two types: direct loss or indirect loss. So we will discuss these in more detail next. So liability risk. Liability risk involves the chance of loss arising from a person's legal obligation to pay damages. This may result from injury or death of another person or damage to another person's property. So remember PPL: personal, property, liability. So exam tip: if the question asks from the three broad categories of insurable risk, remember personal, property, liability. So now let's focus on property risk. There are two types of property loss: direct loss or indirect loss. Direct loss. A direct loss involves damage to or destruction of the property insured. For example, a fire destroys a house. The cost of rebuilding that house is a direct loss. If a car is damaged in a collision, the cost of repairing the car is also a direct loss. If a gaming console is stolen, the cost of replacing the stolen console is a direct loss. So, direct loss, damage to the property itself. So, indirect loss. An indirect loss occurs because of a direct loss. For example, Enzo rents a basement suite in his house. If the house burns down, the house suffers a direct loss. But now Enzo also loses the rental income from his tenant. That lost rental income is an indirect loss. Another example, in a retail store, if a fire severely damaged the store, the business may have to close during rebuilding. The business may lose sales income. That lost income is an indirect loss. So example, think of this way: fire damages the building. Direct loss. Business loses income because the building is closed. Indirect loss. So exam tip: the easiest way to identify them is direct, property itself; indirect, loss because of direct loss. Now let's look more closely at liability risk. Liability risk is connected with the person's legal obligation to pay damages. The obligation can arise because of injury or death of another person, or damage to another person's property. So several areas where liability can arise. First is conduct, operations of vehicles, ownership or occupancy of property, manufacture of products, and rendering professional services. Imagine a person is legally responsible for injury another person. If that person has a legal obligation to pay damages, this represents a liability risk. So exam tip, when you see legal obligation to pay damages, think liability risk. So let's move to the categories and classes of insurance. So insurance falls into two broad categories: general insurance, life insurance. General insurance includes property insurance and casualty insurance. Life insurance is a separate category from general insurance. So agents and brokers selling life insurance require a special life license, while agent and brokers selling general insurance require a general insurance license. So now general insurance is usually grouped into three broad categories: personal lines, commercial lines, special risk. Personal lines relates to individuals in their private capacity. Example include private dwelling contents, automobiles, seasonal dwellings, boats, jewelry, furs and vacations travel insurance. Commercial lines relates to commercial operations. Example include stores, professional offices, trucking operations, construction vehicles, contractors and large commercial operations. Special risk relates to areas such as marine exposure, aviation and high risk industries operation. So remember PCS: personal, commercial and special. And remember, personal, individuals; commercials, businesses; special, marine, aviation, high risk industries. Now we come to another very important insurance term: peril. A peril is an event that may cause a loss. Insurance is provided against loss arising from the occurrence of an insured peril. Let's make this simple. A peril is the event that caused the loss. For example, if a house is damaged by the cooking fire, so the fire is peril. The peril is fire. If a car window is smashed by a riot, the peril is riot. The textbook also gives examples involving negligence, burglary, robbery, theft, dishonesty, embezzlement, and forgery. Equipment's breakdown insurance covers perils such as breakdown and explosion. Example: suppose a cooking fire starts in a kitchen and spreads through a house. The event causing the property cause is the fire. Fire is equal to peril. Exam tip: remember, peril, event that causes the loss. So now we need to make an important distinction.
Peril is not the same as hazard. A hazard is a condition that may cause a peril to occur or make the loss more severe. Here is a simple way to understand it. The peril causes the loss. The hazard increases the possibility or severity of the loss. So here's an example. Imagine a building has a leaking pipe. The leaking water causes damage. The water is the peril. But if the property owner neglects to repair the leaking pipe, that condition can make the loss much worse. That neglect is the hazard. So remember, peril causes the loss. Hazard causes the peril to occur or make the loss more severe. There are two major divisions of hazard discussed in this material: physical hazards and moral hazard. So let's start with the physical hazards. Physical hazards refer to the subject matter of insurance and concerns facts that can be identified through inspection of the risk. Examples: constructions of the property, manufacturing processes, age of a vehicle, and location in relation to water supplies for firefighters. There are some examples: slippery floors, loose tiles, debris in basements or stairwells, poorly maintained heating and air conditioning units, bare electrical wires, dangerous manufacturing process, and poor housekeeping. These are physical conditions that increases the possibility or severity of loss. So example, suppose a building has electrical wires. That physical conditions can increase the chance of a fire. Therefore, the bare electrical wires represent a physical hazard. So exam tip: physical hazard is equals to condition that can generally be identified by inspections. So moral hazard. Moral hazards comes from the human elements of risk. It relates to the character or characteristics of the insured and can involve dishonesty, fraud, carelessness, or poor management. So here's an example involving an insured who deliberately exaggerates an insurance claims. For example, suppose Mark has a small vehicle accident. The actual damage is minor, but when he reports the claim, he falsely says the other driver caused the accident, exaggerates the damage to the vehicle, and falsely claims significant injuries. He even obtained fraudulent assistance to support his injury claim. This is an example of moral hazard because the person's dishonest behavior increases the potential for an improper or fraudulent loss. Moral hazard can also involve characteristics such as a history of dishonest dealing, repeated bankruptcies, or associates with non-criminals.